Hello, Amanda, able to hear?
Yeah.
Okay, good. So we continue with our lesson. You come to this page number 356. When you are here, you let me know. Then we start.
Okay.
Okay, good. So in the previous lesson, we have learned until here the net profit margin. We have learned the first few formulas, the gross profit margin, the markup, and then the net profit margin. Okay, so today we look at the last profitability ratio. Okay, because according to the first page, there are 4 profitability ratio. Okay, and then we are going to look at the last one and then continue with the rest of the formulas. Okay, so let's look at this. We start by writing down the formula. So you write equal, draw a fraction. On top, you write profit for the year. The denominator, you write capital employed. Here is a new term to learn, capital employed. Capital employed is not capital. So you further expand the formula like what I'm doing here. Draw a fraction once more. On top, write profit for the year. Denominator, you write NCL plus capital. So that is what capital employed is. Capital employed is the combination of non-current liability and capital. Basically, this formula tells us how able is the business, how able is the business in generating profit using the funds available. Okay, that means their ability. We are looking at their ability by calculating this return on capital employed. So the name of the formula is return on capital employed. Okay, once you have calculated this, you would be able to see how able, okay, that means we would be able to see the ability of the business in generating profit using the funds available. Funds available here refer to the capital employed, the funds available. Okay, and then, sorry, I left out 100. Okay, I left out the digit 100. Okay, so yeah, that's the formula. Final answer would have a percentage as the measurement unit. Okay, so this number, the higher the better. The higher the better. So if you write down higher better. The higher it is, it means that the business is very good in using the fund in generating profit. I give you 50 cents, you give me $3 the next day. That means you are very good in making money. Okay, so you try to calculate using the example on the left. What is the ROCE? Okay, you try and then you tell me what you get. But once you have gotten the number, you can round it off to 1 decimal place will do. What you managed to get? Okay, so very sure. Sorry, what you said?
I forgot the times 100.
Oh, you forgot the times 100. Okay.
3.2.
Yeah, correct. 3.2%. Correct. So what 3.2% means? The interpretation is here. So here it says, for every dollar of capital employed, the business was able to generate 3 cents. That's the meaning. So that's the reason. This figure, this percentage, the higher it is, the better. Okay, so this number alone is meaningless. This number alone is meaningless. for it to be meaningful, you have to compare the return on capital employed with the earlier years return on capital employed. Okay, you have to compare with earlier years return on capital employed. So I call this as ROCE. Okay, for the sake of saving time in pronouncing it. Okay, ROCE. So now you look at the right, there's an example too. So if you still remember, according to the accounting equation, this C is also known as E, right? E stands for equity, C stands for capital. You use the word capital when you are doing business, when you are doing the accounting for sole trader business. You use the word equity when you are doing the accounting for company, okay, company. So the example two is a company's scenario, okay. That means that this equation can also be stated as profit for the year over NCL plus equity, because capital is same as equity. Okay, so in the context of company, we use the word equity, 10 times 100, then you can find the same measurement, return on capital employed. Okay, so you try the next one, example two, see what you get for the ROC.
3.2.
Same amount, yeah. Because I created this example myself, I made it the same. So 3.2%. Okay, well done. So once again, this amount itself is meaningless. We have to compare with the previous year's ROCE or the later year's ROCE for it to be meaningful. So when you are doing comparison in the exam question, when you notice that ROCE has increased, maybe from 2% to 5%, so what does it mean? You have to comment with this line. You have to comment that the business has become more efficient in making use of its available fund. Add a few words behind, which I left out, in generating profits. In generating profits. Okay, more efficient means very good. Okay, very good in generating profits using the funds available. If, on another hand, the ROCE has decreased, that means the business has become less efficient in making use of its available funds in generating profits. Okay, so standard answers are always standardized when it comes to giving comments as to why it has increased or dropped. Okay, so following this, for sure you will not make any mistake. Okay, now we go and do some questions for this one. We look at okay, we come to page 367. 367. We do the question J. So it's asking you what is measured by the ROCE. So basically, it's asking you what we are trying to get from this calculation. So let's write this together. The efficiency of business Okay, once you're done, I let you try the part K. Okay, and then you tell me the answers.
Is it?
Okay.
First one is increase.
Okay, first one increase. I tell you whether it has right or wrong later. You continue with the rest. The rest you have finished.
Decrease.
A decrease and then
No effect.
okay. So let's see whether these are correct. Directors have made 3 proposals. When you see the word director, it means that you are doing a company's accounting question. For increasing the ROCE, directors want to increase the ROCE, and he has suggested 3 ways to increase the ROCE. So we have to use tick to answer. Reduce cost of insuring motor vehicles. So first and foremost, we have to understand the formula first. On top here, you have profit for the year. And then here you have NCL and capital. Profit for the year is the number from the income statement. Income statement last item is profit for the year. That means if there's any change to any item in the income statement, profit for the year would be affected. And thereby ROCE would be affected. Okay, so reduce the cost of insuring motor vehicle. This would make the expenses reduce, and then profit for the year would be higher, then ROCE would be higher. Good. Okay, so increase. Issue more ordinary shares. This would make the equity increase. So therefore ROCE decrease. Okay, correct. Last one, obtain a short-term interest-free loan. Okay, it's very lengthy, but focus on what is about. It's about a loan. Loan is a liability. NCL or CL, it says short term, so this is current liability. So any effect? No, because there's no current liability in the formula, right? So no effect. Okay. Now we look at next question. We do one more on ROCE, then we get back to the notes to look at other formulas. Hope we can finish this topic today. Okay, we come to page 375, question F. Okay, so here 2 reasons for the change in the ROCE. So what is the change? We have to see the question. So whether it's increase or decrease, look carefully, 6.13 up to 8.27, there's been an increase, right? And also look carefully at the date. We read from the left to the right, okay, 2017 to the right, 2018. So it has increased 2. So we have to give 2 possibilities. So once again, look at formula. Look at formula. It could be profit for the year has increased, right? So we write profit for the year could have increased. Okay, also look carefully if they have given you profit for the year. If it is loss for the year, then our answer would be wrong. Okay, it appears that they have not given us profit or loss for the year. Okay, but our answer is right. Our answer is just a suggestion. We do not know the exact reason. We do not know the exact reason. They only ask us to suggest. Okay, so second possible reason, we can talk about the non-current liability. Let's see if they have given us any NCL. No. So we can say that they could have taken a long-term bank loan. Okay, so we write the name of business. Name of business is risk one. Risk one. Okay, so we use the word risk one. Risk ones could have taken a long-term bank loan. So must write the word long-term, okay, to make it an NCL. Okay, once done, let me know.
Done.
Good. So I think that's it for now. We head back to the notes. We learn the rest of the formulas. Page number 357. Okay, so the first half of the page. So on this page, there are 2 formulas. We look at the first one on top. current ratio. So let's write out the formula first. Formula for this current ratio can be gotten from the first page. Okay, but if you don't refer, you can follow me to write it here. The one on the top is current assets. The one at the bottom is current liabilities. So what this formula is trying to tell, I'll tell you soon. So after you have this, so this is a division, right? This is a division. After you have done the calculation, your answer is in the form of a ratio. Is in the form of a ratio, a number to 1. The number that is on the right is always 1. And once you have done the calculation, your answer would be on the left of the ratio, always. Okay, so what are we trying to get using the formula is to see how much current assets we have compared to the current liabilities that we have. So what is current assets? Current assets, you could have inventory, trade receivable, other receivable, cash or bank. Current liabilities, you could have short-term loan, trade payable, other payable, and bank overdraft. These are debts, right? Debts that we have to pay. Okay, we have to pay off these debts. If you don't have current assets, can you pay off the current liabilities? Cannot, right? So you must have enough current assets to pay off the current liabilities. Okay, so you need to have enough current assets to pay off your current liabilities. That's why we make a comparison between CA and CL. And now you think of other assets that you may have, NCA, non-current assets. So what are NCA? They are the things that you use in your business for more than a year. For example, you open a factory, you have machinery, maybe you open an accounting firm, you need to have furniture. Okay, you run a restaurant, you also need furniture, and so on. So can you sell off these things to pay for current liabilities? No, right? Because you need them in your business in the long term. So it is impossible to use NCA to pay off your current liabilities unless you want to close down your business. That is the reason we can only see how much current assets we have. Then we compare with the amount of current liabilities. Then we would know whether we are able to pay off the current liabilities or not. Okay, so ideally we should have more current assets, right, than the amount of current liabilities we have. So there's one number which is known as the ideal current ratio. It is 2 to 1. It is 2 to 1. And then you may have a question, why shouldn't it be 1 to 1? If you have one part of current asset to one part of current liability, then you have just enough CA to pay off your current liability, right? So 1 to 1 seems good, but actually it's not good enough. It has to be 2 to 1. Reason is this. Do you think people would want your inventory as payment? For example, you run a 7-Eleven and you owe somebody $50,000. Do you think that person would accept your goods, all the things that you have in your 7-Eleven, you use them as payment? No, right? People do not want your goods. People want money. So that's the reason inventory is the least liquid current asset. Least liquid current asset means, so you write down, it takes the longest time. It takes the longest time to be converted into money. Take the longest time to be converted into money. Okay, so in all businesses, you should have some inventory. That's the reason it's better to have a higher current ratio. Okay, so 2 to 1 is the ideal number. Why 2 to 1? I do not know, but that's the benchmark that everybody use. The best current ratio is 2 to 1. Okay, so you try to calculate using the example at the bottom left here. You see how much is the current ratio? It's quite easy.
2 to 1.
Yeah, correct. 2 to 1. Okay, 10,000 divided by 5,002. Okay, so 2 to 1. So this is very good. This is very good. And why is there an ideal 2 to 1? Why we don't call it as more at least 2 to 1, then it's good. Okay, what I'm trying to say is when your current ratio is too high, maybe 4 to 1, yes, it may seem good. You have 4 parts of CA to 1 part of CL. You have a lot of CA to pay off your current liabilities. It seems to be very good. So does it really mean that when you have a very high current ratio, it's very good? Not really. When it's too high, it's actually there's something wrong with it. When it's too low, it's definitely not good. So why when you have a high current ratio, it's not good? Reason is you try to think when you have too much inventory, so do you think it indicates that your customers demand have gone down? That means not a lot of people come to you and buy your things. Possible, yeah. Right? So too much inventory means not good. Okay, so next one, look at the next current ratio. When you have too much trade receivables, is it good? It means that you are not good in chasing money. Okay, you are not good in getting your customers to pay us. Okay, so there's a risk of irrecoverable debt. Agree? So too much trade receivables means you are collecting your money too slowly from your customer. You are not good in chasing money from them. Okay, so once again, too much means not good. Okay, cash and bank. Bank is the money in the bank account. Cash is the physical money that you have. When you have too much cash and bank, it seems that it's good. But in the business, your purpose is to make money, right? You want to make as much money as possible. When you have too much money in the bank, when you have too much cash, it indicates that you are not making good use of the money in maybe expanding the business. So if you have too much money, it's better to invest it somewhere else. Maybe you enlarge your business so that you can make even more money. Okay, so having too much money, it also indicates that you are not good in running your business. You are too conservative. You are not good in taking good. You are not. You don't like to take risks. You don't like to take risks to enlarge your business. Agree? So once again, too much, it doesn't mean it's good. Okay, so you look at the bottom right here, there's a box. This is what you need to comment with when CR is too high. So example, so how high is too high? There's no benchmark, to be honest, but don't worry, in the exam, they will give you some extreme current ratio to show you that it's too high. So for example, so 2 to 1 is ideal, right? How much is too high? Maybe 2.5 to 1. Okay, so to me, in my opinion, at least 2.5 to 1 is considered too high. Okay, you have too much current asset. So what you need to comment with, you have to say the business has more than enough or excessive CA to pay off its CL. Okay, and then if it's a 2-mark question, you continue to write business is not making good use of its fund to earn returns. And then you continue to write perhaps, comma, perhaps by expanding the business. Of course, it is once again, it's a matter of opinion. Okay, some people do not want to take risks. Some people want to maintain the size of the business. They don't want to make it too big. They just want to earn a reasonable level of profit. Okay, it depends on the individuals. Okay, then how low a current ratio is too low? I give you an example. 1 to 1, okay, 1 to 1 to 1, 1.1 to 1 is considered a low current ratio. So once again, if we are looking at some questions, I would remind you whether it's low or high. Okay, so when it's too low, some questions would ask you, what does it indicate? Okay, so you have to comment. So we say that the business doesn't have enough CA to pay off his current liabilities because not everybody wants your goods, right? Not everybody wants your inventory as payment. And then next line, you may say the business is in a bad liquidity position. Liquidity position, you write down the meaning. Liquidity position means cash flow health, cash flow position, or cash flow health. It means that when somebody tells you you are in a good cash flow position, you have a lot of money. Okay. And when somebody tells you that you have a bad cash flow position, that means you are lack of money. Okay. And then if the question is a 3-mark, if the question is a 3-mark question, then you continue to write, the business may face the risk of bankruptcy. Bankruptcy means closing down. Okay, closing down. Okay, so since inventory is the least liquid CA, okay, least liquid CA, just now I say, it means it takes the longest time to be converted into money. Okay, why inventory takes a lot of time to be converted into money? Reason, you need to wait for customer to come and buy, right? Okay, so you have to wait. Okay, you have to wait for customers to come and buy. And even worse, they may come to you and buy on credit. When customers buy goods on credit from us, have you gotten the money? Not yet, right? So once again, you have to wait. Okay, so you have to, firstly, you have to wait for customers to come and buy from you. And if they buy on credit, if they buy the goods on credit, inventory will go down, trade receivable will go up. Okay, so trade receivable is not money, right? You still have to chase the money from them. So, and then once again, you wait until they settle the debt. If even worse, they run away, then you don't get the money. Okay, so that's the reason. Inventory takes the longest time to be converted into money. Okay, we call it the least liquid CA. So we have a more sophisticated formula than the current ratio, where we are going to remove the inventory, which is the next formula, acid test ratio. Acid test ratio is also known as quick ratio. It is also known as liquid ratio. These three terms are synonym to one another. So the formula, you copy from the first page while I go and charge my laptop. Okay, you copy from the first page. Okay, so you should have copy. This is a fraction as well. CA minus inventory over CL, right? Okay, equals to a ratio as well. Okay, the number on the right is always 1. The number on the left is the result of doing the calculation here. Okay, so CA minus inventory divided by current liability, then you write the number on the left of the ratio. Okay, that's the answer. Okay, so the reason why you have this formula is like what I mentioned just now. Because inventory is the least liquid current asset, nobody wants your goods as payment. That's why it's more logical to remove the inventory. Okay, when you are trying to see we are able to pay off the current liability or not. So this is why you have acid test ratio. It is used to determine whether the business has sufficient liquid current assets. You must have the word liquid when you are making any comments about acid test ratio. Liquid current assets means current assets that can be converted into money easily. Current assets that can be converted into money easily. Okay, you may write down CA that can be converted into money easily. That means the other way around from inventory. For inventory, it takes the longest time to be converted into money, right? But for other current assets like trade receivable, cash, and bank, they are known as liquid current assets. Okay, because they can be easily converted into money. So to determine whether the business has sufficient liquid current assets, used to pay off is current liabilities. Okay, so it's a stricter measure of a business liquidity position because it has excluded the least liquid CA, the inventory. Okay, so this line have to remember. Some question would ask you, why exit tax ratio is better than current ratio. Later, I will show you the question. Okay, so this line, later you're going to make use of it. Okay, now, just like current ratio, the ideal one is 2 to 1. Okay, the ideal current ratio is 2 to 1. There is also an ideal number for exit tax ratio. The ideal number is 1 to 1. 1 to 1. So when it's more than 1 to 1, that means it is it's slightly bad because you have too much fund. When it's less than 1 to 1, that means it's bad. Okay, as well. So you use the example here. You try to calculate both the CR and ATR. CR stands for current ratio, ATR stands for exit tax ratio.
Hello? 1.
1. For which one? CR or ATR?
For ETR.
ATR, okay, 1 to 1. Okay, what about current ratio?
Mm,
You can round it off to 1 decimal place if you get any.
3.7.
No. Okay, hold on. Yeah. For the ATR just now, did you get decimal places? You try to round it off to 1 decimal place, see what you get.
Oh. 2.2.
2.2 for the current ratio, right? Okay. Okay, and then the ATR, you try to leave it having 1 decimal place, see what you get.
2.2 for ATR, I think, and then current ratio is 3.7.
Oh, both wrong. Okay, you see how I calculate. Okay, you see how I calculate. So current ratio formula is CA over CL, right? Total CA over total CL. So which means you have 115,000 on top over current liability. Is this what you use? 115,000 divided by 53,000. You should get 2.2.
But with the inventory, right?
Yeah. This has included inventory. This amount has already included inventory. This amount has already included inventory. You don't have to plus the 80,000.
Okay, then I read.
Okay, so this should be 2.2 to 1. Okay, and then the ATR. So based on current ratio, does it look good? Yes, right? 2.2 to 1, right? Around the ideal 2 to 1. So this looks good. 2.2 to 1 looks good. Okay, now ATR. You have to take the total CA 115,000, remove the inventory 80,000 over 53K. Okay, see what you get.
0.7.
Yes, correct. So is this 0.7 to 1 good?
Okay.
Not bad. It's bad. It's bad because it's less than 1 to 1. The ideal one is 1 to 1, right? So 0.7 to 1 is considered bad because you don't have enough liquid current assets to pay off your current liabilities. So conclusion is this. Whenever you get questions about something like this, they would always ask you to calculate both current ratio and ATR. And current ratio looks good, but ATR looks bad. So which one should you follow? ATR. ATR is stricter, right? So it's better to look at ATR. Okay, so what you should write when it comes to giving comments, here is a paragraph to guide you. Let me highlight for you. Firstly, you say that current ratio indicates business has sufficient CA to pay off its current liabilities, hence is in a good liquidity position. Okay, and then you use the word however to talk about another thing. However, ATR indicates business doesn't have enough liquid CA to pay off its CL. Hence, is actually in a bad liquidity position. Okay, so yeah, these are what you need to comment with. So from time to time, when you have done enough questions, then you would know what to write. No worries. Okay, no worries for now. Okay, now on the right, you see the box there. Here is also some guide on how to write the comments. When it's more than 1-to-1, you should write the business has sufficient liquid CA. Once again, the word liquid must be there to pay off its current liability. Hence, is in a good liquidity position. Another way around, if it's less than 1-to-1, you say that the business doesn't have enough liquid CA to pay off its current liability. Once again, must have the word liquid. It's in a bad liquidity position, may easily face the risk of bankruptcy. Okay, so that's it for these two formulas, current ratio and exit test ratio. In some questions, they may ask you, how can they improve the liquidity position? That means, how can they improve the cash flow health? So here are some ways that you can make use of to write the answers in the exam. First one, take long-term loan. Okay, so see what happens when you take long-term loan. You debit cash or bank, depending on what form of money you receive for the loan. Okay, so you debit cash and bank when you get the loan. Then you credit long-term loan. Long-term loan is an NCL, right?
Yeah.
NCL increases. Okay, so when NCL increases, both the current ratio and test ratio will not be affected, right? Because NCL are not involved in both the formulas. Okay, so cash and bank is current asset, right? So current asset would increase. So you agree? The first way can improve both the ratios?
Yeah.
Yes, right? Because CA increase, NCL increase as well. Okay, second one, when you delay purchase of NCA, when you delay purchase of NCA, you would have more current assets available. Agree? When you buy NCA, you need money, right? But if you delay the purchase, then you will have more current assets temporarily. Okay, so this is one way as well. Number three, reduce drawings of cash, bank, or inventory. That means you take less things from the business for personal use so that you can keep more current assets in your business. Okay, so this can also improve the liquidity position.
Okay.
Okay, now we do some questions on these two. Hold on, yeah, let me show you which page. You may first look at page 369. You try to calculate these two amounts, current ratio and quick ratio. Okay, and then you see they would indicate to you how many decimal places to have. Okay, they say 2 decimal places. Okay, once you have gotten the figures, you tell me. So you can get the numbers from page 368. Okay, all the numbers are here. And then you plug into the formula, then you can get the final answer.
Okay. 1.54 to 1 and 0.
Amanda, you managed to get the numbers?
Yeah.
Okay, you tell me the numbers.
1.54 to 1 and then 0.81 to 1.
Okay, so I show you the answers here. Okay, correct, good. 1.54 to 1, 0.81 to 1. So in the first place, of course, we have to memorize the formula because we would not be given the formula sheet. So 1.54 to 1. Don't just write 1.54, okay? You will be wrong. You have to write it in ratio form. Okay, so what we can see here is the 2017 is on the right, 2018 is on the left. So it's not always standardized. So you have to look carefully. You should read from the left to right or right to the left. So this time you have to read from the right to the left. We can see that current ratio has decreased. Quick ratio has also decreased. Okay, so both looks bad. Okay, we look at the B. Suggest two reasons for the change in current ratio. Okay, very easy. If you know the formula, you know what has changed. Current ratio CA over CL, right? Only two possibilities. First possibility, CA has decreased. Second possibility, CL has increased. Agree? Okay, so we write the answers. Very easy. We write okay, second one. Okay. Okay, once you are done with this, you look at the C. So this could be the most difficult, most challenging kind of question for every formula kind of question. So you try to see, and then you tell me your answers. So have to look carefully for each of these.
Okay.
It's asking you how each of these action could affect the current ratio. So once again, use the tick.
First one is increase, then decrease, decrease, no effect.
Okay. Let me place the ticks for you. Like this, right? Okay. So I show you the answers. Okay, so a bit of mistakes. Only one mistake, the second one. Okay, the second one. So let's try to understand the second one. The rest correct, right? Okay, the rest correct. The second one answer is no effect. So why no effect? It says sell half the inventory at cost price to a cash purchaser. So it means that you sell at cost price. So cost means the price for which you bought from supplier, right? And now you sold at the same price to the customer. Would you make money? Would you make money?
No.
No. So no gain, no loss. Okay, no gain, no loss. It means that you sell at the same price which you bought from the supplier at. So you don't make money. It is simply an exchange of current asset. your inventory will go down. Okay, maybe by 1,000. Okay, inventory go down by 1,000. Your cash will go up by 1,000. So CA, no change because one CA increase, one drop by the same amount, right? And CL not affected. That's the reason no effect. You can understand?
Yeah.
Okay, so both inventory and cash go up and go down respectively by the same amount. CL no change, so no effect to the current ratio. Okay, now let's do one more, then we get back to the notes. Okay, D, next page, question D. It's asking you, explain why the exit test ratio is more reliable than the current ratio as an indicator of liquidity. Basically, it's asking you why exit test ratio is stricter. Okay, why exit test ratio is stricter, why it is better. So it's about the inventory, right? The answer you can get from the notes, you copy and paste at home yourself. Answer is the line that I talked about just now, the one in purple. This is a stricter measure of a business liquidity position because it has excluded the least liquid current asset inventory. Okay, just copy this entire line, then you'll get the full marks.
Okay.
Okay, yeah, so we move on to the next one. Okay, we look at the E. Comment on the change in quick ratio. Comment on the change in quick ratio. So comment on the change. So we look at the change. What is the change in quick ratio? It has dropped, right? 1.15 to 0.81. Okay, firstly, we write it has dropped. Then you will get 1 mark. So we write it has dropped. Okay, so next we tell the possible reason why it has dropped. We can talk about the current liabilities. So possible reason for the drop is an increase. It's an increase in current liabilities. Okay, while you're writing, let me see the mark scheme. 5E. So you see 5E at the bottom right. Firstly, we say it has decreased. Okay, it has decreased. So you try to compare this question E with the question B. These two, they're asking you to comment, but the first one is asking you to suggest 2 reasons for the change. So you don't tell what is the change for current ratio. Okay, unlike the question E, they ask you to comment on the change. 2 different kind of question. If they ask you to comment on the change, then you first write it has dropped. You will get 1 mark here. But for the current ratio just now, they ask you to suggest 2 reasons. If you tell them it has dropped, would you get mark? You will not get mark. You get what I mean?
Yeah.
Here they ask you to tell 2 reasons. They don't ask you to tell the change. Okay, but the one for E, they ask you to comment on the change. First line you can write it has dropped. Then you will get 1 mark first. Then only you write the reason. Okay, yeah. So that's for E. Okay, so not very difficult so far, as long as you know the formulas. Okay, now next page, page 371. We answer this and then we get back to the notes. Page 371G. What is measured by current ratio? Okay, let's write this together. Okay, after you have done, you look at the H, you calculate for the H, then you tell me what you get.
1.34.
Okay, I show you the answers. Yours is correct. Okay, so 1.34 to 1. Okay, good. Okay, now we get back to the notes. We learn the rest of the formula. For the homework that you have done, we discuss them another time, okay? Because I wish to finish off learning first. So come to page 358, 358. So this page, once again, two formulas on the same page. Firstly, you have the trade receivable collection period. Okay, so it's a very long-term trade receivable collection period. Synonym, trade receivable turnover. Which term you will see in the exam? You will see this term in the exam. The term that is on the left, that term it had been existing up to only exam in 2019. From 2020 onward, they use this term trade receivable turnover. So of course, for your new exam sitting, you will see this term trade receivable turnover. Measurement unit is days. Now we write down the formula. Formula looks like this. A fraction times 365. Final answer days must be a whole number. Cannot have decimal places. Must be a whole number. On top here, you have bottom, you have okay, credit sales. Credit sales means the amount of sales for which is on credit. Okay, you sell goods on credit.
Okay.
So this formula tells us how good are we in collecting payment from our customers. Okay, so for this amount, sorry, this is not amount. For this figure, okay, number of days, the lower it is, the better. The lower it is, the better. When it is low, it indicates that we have taken a short period of time to collect from our customers. It's good. When it is a long period of time, maybe 60, maybe if you get a number like 100 days, is it good? No. It means that on average, you have taken 100 days to collect payment from your customers. It's not good. It's too long. Okay. So yeah, that's what you have. So this purpose you read on your own. Okay, that's what I have mentioned just now. Now you try to calculate using this example, see what you get. One thing about the final answer you get is it must be in whole number. Secondly, you must always round up, regardless of the number, whether usually in math, when it is at least 5, you round up, right? When it's below 5, you round down. But for this formula in accounting, you must always round it up, regardless of the number. If you get maybe 2.1, if you get 2.1 days, you round it up to 3. Okay, so you try this one.
35.
35, yes, correct. So you should have taken 75K divided by 800,000 times 365. Then you get 34.2. Round it up, you will get 35 days. Okay, good. So this number itself, good or not, we cannot comment yet unless you have been given other information. So it depends on how much time you have allowed your customers to settle payment. Then only you know that whether this 35 is good or not. Okay, here on the right, we read this. It says whether TRCP is good or not. It depends on how much time you have allowed your customers to settle the debt. So example, we use 30 days. If we have allowed them 30 days, then is 35 good?
No.
No, because you have taken 5 more days on average to collect from your customer. It's not good. So as far as theory questions are concerned, these are what you may write. If it is more than 30 days, so the ones in blue are advantageous, the ones in red are disadvantageous. So not all the time when it is a bad number, it is all the way disadvantageous. So you see what I have written. First line I've written you would experience tighter cash flow position. And okay, but you can charge them interest, right? You can charge your customers interest. And then next, second good thing is you don't have to give them cash discount. And this is a general or neutral sentence. You may stop supplying to them until they have settled the earlier debts. Okay, so this is something neutral. And there's risk of bad debt. There is risk of bad debt. Okay, because the longer they owe to you, the longer the customers owe to us, there is a higher risk of bad debt. Then doubtful debt may also arise. Okay, so once again, it depends on what the questions want you to comment with. Okay, accordingly, you give the answers that they want. Okay, later we look at the questions. On another hand, if less than 30 days, that means it's good. You allow your customers 30 days to pay, but they spend less than 30 days to pay you. So this is good. But once again, it's not all the way good. Okay, because you have to give them cash discount when they pay you promptly, right? You have to give them cash discount. So it's something bad to us because you would collect less money. But you would experience better cash flow position. There's less risk of bad debts. Okay, so these are what you have. These are what you may write in the exam when they give you theory questions about TRCP, trade receivable collection period. Okay, now the next formula. So when you are looking at trade receivable collection period, we are the supplier. When you are looking at this formula, we are the supplier. When you are looking at the next formula, trade payable payment period, we are the customer. We are the customer this time. So this formula is the other way around. We see how much time on average we take to pay to our supplier. Okay, how much time on average we take to pay to our supplier. So the formula looks like this. We write down. On top, you have trade payables. Denominator, you have credit purchases times 365. Okay, once again, this number, you must remember the two things like the one you have for trade receivable collection period. Firstly, it must be a whole number. Secondly, must always round up if you get decimal places. Okay, now you try. So what do you think? The lower the better or the higher the better? This figure that you get. Sorry, is days, okay? Days, measurement unit is days. Higher better or lower better? Yeah. Yeah, lower better. Because so that the suppliers will not get angry, right? So that the suppliers will not get angry. Okay, you use this example, you try to calculate what is the you change this short form. I have made a mistake here. It should be TPPP, trade payable payment period.
Okay.
And then you calculate, you tell me what you get.
Um, 35.
Yeah, it's the same number 35 because I make it like this. Okay, so 35 days. Once again, this number is good or not, it depends on how much time the suppliers has allowed us to settle the debt. Okay, how much time the suppliers has allowed us to settle the debt. Once again, I use the 30 days as example. Okay, so when your TPPP is more than 30 days, that means you have taken longer time to settle the debt that you owe to the supplier, right? But there's one advantage. You would experience better cash flow position because when you keep delaying payment to the supplier, it means that you are indirectly borrowing this amount of money for a short period of time, okay, for some time. So you would experience better cash flow position, but suppliers will charge us interest, which is bad, and we don't enjoy cash discount, which is bad. Suppliers may stop supplying to us because they get angry, and our relationship with supplier would be bad as well, would become worse. Okay, on another hand, if you have taken less than 30 days, suppliers would be happy, but we would experience tighter cash flow position, but we can enjoy cash discount. We can enjoy better relationship with the supplier, and there is less risk of discontinued supplies from them as well. Okay, so all these points are quite straightforward. Okay, so let's see some questions on these two formulas before we continue. Trade receivable collection period and trade payable payment period. We look at the questions. Okay, page 361. Question B. So this is an easy question. State the formula. So don't calculate, okay? Don't calculate. They say state the formula. Some students may misunderstand this question, thinking that they have to calculate. So just state the formula times 365. Then this is trade payable payment period. So it's an old question because they use the term trade payable payment period. In the new exam setting, you would see this as trade payable turnover, trade payable turnover. So you write trade payable on top, then credit purchases. Okay, after that, have you done the part A? Because you need the part A to answer the part C.
No.
Not yet. Then hold on, yeah. Okay, for the C, you cannot do then because you have to find. Hold on, yeah. Let me see if you can do. You can do. Sorry, you can do. So you have been given credit purchases here. And then for trade payable, you can use this, the one at the year end. Okay, and then you calculate for the C, see what you get.
Okay. 45.
Good. So I show you the answers. Is 45. Okay, bottom right corner. Okay, 45. Good. So simple. Now next one. Question D. State whether Kumu suppliers would be satisfied with a trade payable payment period. Okay, it's asking you whether suppliers would be happy or not. So you have to see. Looking at the 45 is meaningless, right? You have to see how much time suppliers allow us to pay.
Yeah.
Okay, so do you think suppliers would be happy?
No.
No, because they allow us 30 days. We spend more than 30 days to make payment to the supplier. So firstly, we say no. Okay, reason, we compare the figures. So we write has taken more 15 days more, right? Okay, so Kumu has taken Kumu has taken on average 15 more days to settle debt owed to the suppliers. Okay, and then we answer the E. State two problems Kumu may face if a trade payable payment period is unsatisfactory. So we have to comment what could be the consequences. May get charged interest. Okay, suppliers may charge Kumu interest. And second problem, Kumu would not be able to enjoy the cash discount. Okay, now we look at the next one. Next one, we look at okay, we look at this page. Page number 366. 366. Okay, question E. Comment on the effect on the liquidity. So when you look at the word liquidity, liquidity means the cash flow health of ABC Limited, of the change in collection period for trade receivable. Collection period for trade receivable means trade receivable collection period, and the change in payment period for trade payable. So this time we have to comment on the effect of the change of these two numbers. So it has, for collection period, it has increased. Payment period, it has also increased. Okay. Customers are allowed a credit period of 30 days. And now it has become worse, right? Okay. Customer has taken longer time to pay us.
Yeah.
Credit suppliers allow a credit period of 24 days. Okay. Once again, we have broken the rule. We spend more than 30 days. Okay. So let's write together. So one mark would be for commenting on collection period. The other mark would be for commenting on the payment period. So we write for collection period. ABC would experience worse liquidity position as credit customers have taken on average 10 days more to settle debt owed to ABC. Okay, and then we talk about suppliers. ABC Okay, once you have written, you let me know. We do the F.
Okay.
Okay, question F. Two ways in which ABC could reduce the collection period for trade receivable. That means you want to reduce the collection period for trade receivable. You would like your customers who owe you money to pay you earlier. You want your customers to pay you earlier. Okay, those who owe you money, you want them to pay you earlier. So you must encourage them, right? One way to encourage them is by offering cash discount. So offer cash discount. Second way of encouraging them, you may send statement of account, okay, to annoy them, okay, keep reminding them to pay, keep sending emails to them so that they would pay us. Send statement of account constantly to okay, once done, let me know. Then we look at other formulas.
Done.
So we get back to the notes. we learn the next formula, which is something about inventory. So page 359. So this is known as inventory turnover rate, or you call it as rate of inventory turnover. Can be used interchangeably. Which term you would see, I do not know in the exam. Okay, both terms can appear. But this time the measurement unit is not days anymore. It is number of times. So we write down the formula, fraction once again. Then average inventory here. Then here you write cost of sales. Only a fraction. And then the measurement unit for the answer is number of times. Okay, so let me tell you what this result would mean when you do the calculation. This result refers to the number of times of restocking. Okay, you write down this is the number of times of restocking in a year. That means for how many times you have placed order with your supplier, okay, to buy the goods. Okay, restock. Okay, restock means you buy goods to yeah, you stock up. Okay, you stock up when you have sold a lot of things, you want to buy more from suppliers so that you have goods in your business, right? It's like you run a 7-Eleven. When you run out of snacks, you have to buy snacks. Okay, restock. So this result is the number of times of restocking in a year. So this number would also indicate how fast you are selling your goods. Okay, say imagine you have a very high number for this inventory turnover rate. So when you get a very high number, it indicates that are you selling your goods fast or slow?
High is fast.
Yes, because when you get a high number, it means that you restock for many times. You restock in a year for many times. That means your goods must be selling very fast. Okay, so high means our goods are selling very fast. Okay, goods are sold at a very fast rate. Okay, so here the purpose, it tells you to determine how fast we are selling our goods. Okay, once again, a single number is not good enough for us to make a meaningful comment. Once again, you have to compare this result with previous year's inventory turnover rate or later year's inventory turnover rate to make a meaningful comment. So here is a box. We read these few paragraphs. Whether an ITR stands for inventory turnover rate, is good or not. We need to make comparison of the ITR in a period with the ITR in the previous period. Okay, make comparison with the early years at ITR. When ITR has become higher, it indicates that you are selling goods faster than before. Agree? Because when you sell goods faster, you have to restock at a higher frequency, right? You have to restock more for a higher number of times. So it also indicates greater volume of sales. Okay, but it may also mean something bad. Probably you have reduced the size of your storeroom. Okay, maybe you don't have enough money to rent a big storeroom, so you have given up. You have given up on the bigger storeroom. You rent a smaller storeroom. I mean, okay. So when you have a smaller storeroom, then your goods would run out faster, right? When you have a smaller storeroom, so it would make you restock for more number of times. Agree? Yeah. So when your ITR is high, it doesn't necessarily mean that it's a good thing. However, it may indicate insufficient storage of inventory. Okay, so it means smaller storeroom. You have a smaller storeroom, smaller storage room, which makes you easily running out of goods. Okay, so that makes you having to restock for a higher frequency. But it allows savings of storage costs. So how much storage cost? So what is storage cost? Storage cost means the money that you spend on maybe renting a storeroom. So it varies from one business to another. In some businesses, their goods are big in size. Some businesses, their goods are small in size. I give you some examples. For Apple company, when they have 10,000 iPhones, do you think they need a very big storeroom? 10,000 iPhones? No, right? iPhones are small in size, right? So, like I said, it depends on what your business is. Okay, say you are running a Mercedes business. Okay, you have a Mercedes showroom. You have 10,000 number of cars. Do you need a very large space to have your 10,000 cars? Yes, right? So, once again, storage wise, it depends on what your business is. Okay, it depends on what your business is. Okay, so when ITR is lower, it indicates that everything is bad. Okay, and when ITR is low, you are selling goods lower than before. It indicates lower customer demands of our goods. It may indicate excessive storage of inventory. You have too much goods, and yeah, that's why you restock for a lower number of times. More storage costs need to be incurred. And maybe your storeroom is too large, so it takes a long time for you to run off your goods, to be running off your goods. Okay, this number, it also depends on what business you run. Say you are selling fish and vegetables. Do you think it's better to have a high ITR or low ITR? Perishable, right? Okay, fish and vegetable perishable. High. Reason? If it is low, it means that your fish and vegetables will be not fresh. Agree? If you have high ITR, it means that you keep restocking your fish and vegetables. That means you can always sell very fresh fish and vegetables to your customers. Agree? Yeah. So for businesses that sell perishable goods like fish, vegetables, meats, so they need to have a very high ITR, so that it means that they are selling very fresh food or ingredients to people. Okay, to ensure quality and freshness of their inventory. So that's what ITR means. Okay, and there's no ideal number because every business is different. Let's do some question on this. Let's do some question on this. A little bit more than we are done, but I don't think we can finish today. But never mind, we try our best. You come to page number 363. Okay, page 363. You try to do G, H, and I. G, H, and I. Okay, when you're done, you snap me a picture.
Yeah, how do I do G?
Okay, how to do the G? You have done the H and I, right? I think you need to do the G first. Without that, you cannot do the I. Okay, how to do the G? Firstly, we look at what inventory we are trying to look for. Inventory at 1st May 2017. So I think this is opening inventory, because if you see the next previous page, inventory at 30th April 2018, between these 2 days, there are 12 months, right? Okay, between these 2 days, there are 12 months. That means they are asking us to find the opening inventory. So you have been given cost of sales, and cost of sales is in the income statement. Okay, it's in the income statement. And you have the opening inventory. So this is closing. This is closing. Okay, and then do you have purchases? Amount of purchases? Yes. Before the part A, you have the purchases. So using these amounts, we can find the opening inventory. So I show you the equation. You have to, so cost of sales, you have the cost of sales equals to opening inventory plus purchases minus closing inventory. You have all other numbers except opening inventory. So with this, you can find the opening inventory. So cost of sales, 205000. Okay, leave this blank opening inventory. Purchases refer to the info given before the part A, the two amounts. Okay, we sum these two numbers. Okay, I found it to be this. Closing inventory, 35,000. So basically, these are the calculations that you do in the income statement, right? After sales returns, and then you have cost of sales, and then all these things. Then you try to find opening inventory.
Three two seven three zero.
I got the same number. So let's see the mark scheme. 32730. Okay, it's correct. Good. 32730. Okay, now the H, I think you can do on your own. Then you calculate the I. Okay, the H you don't have to show me. Okay, you just calculate the I. Then don't have to snap picture. You just tell me your answer for the I. Okay, you do the I. Before that, have I told you what is average inventory? No, right? I left out that. You get back to the notes. This is the formula for inventory turnover rate. You know what is cost of sales, right? But average inventory, I've yet to tell you what it is. Average inventory means is equal to opening inventory plus closing inventory divided by 2. This is average inventory.
Okay.
Okay, with this, you can calculate. Okay, then you tell me your answer.
6.05. Okay, then
Yeah, it's correct. Yeah, you see, 6.05 times.
oh,
Okay, it's correct. So that's it for today. And no homework for this week. And your focus would be on revising the part 6 to part 10. Okay, very soon I will send you the exam papers. And
okay.
next lesson, for sure we can finish everything in here. And then we move on to the rest, part 17 and 18, that are very little things there. Okay, so I see you next week at the same time. Not the same time.
2
2
to
p.m.
3
Yeah,
to.
2 p.m. Okay, yeah, correct. Okay, bye-bye.
Thank you, Jill. Bye
No
bye.
problem.